Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Refinancing and Debt Consolidation Guide. Refinancing and debt consolidation are two strategies that can help you manage your finances more effectively. Refinancing involves replacing your current loan or loans with new ones, often with better terms or lower interest rates. This approach can save you money in the long run and make managing your debt more manageable. On the other hand, debt consolidation focuses on combining your existing loans into a single, more convenient loan. This can simplify your life by reducing the number of payments you have to make each month and potentially help you secure better terms, or a lower interest rate for the combined loan. Understanding refinancing. When it comes to managing your finances, refinancing can be a useful tool. In simple terms, refinancing refers to the process of taking out a new loan to replace an existing one, often with better terms and conditions. This can help you save money and make your financial situation more manageable. Types of loans and interest rates. There are various types of loans you can refinance, including mortgages, personal loans, and auto loans. When refinancing, you should look at the interest rates of the new loan compared to your current loan. Interest rates can be either fixed or variable. Fixed interest rates remain constant over the loan's term, while variable rates can fluctuate according to market conditions. Source. Fixed interest rates provide predictability over the entire loan term, allowing you to plan your payments and budget more effectively. Variable interest rates may offer lower introductory rates, making them attractive initially. However, they can increase in the future, potentially affecting your ability to meet repayments. Advantages and risks of refinancing. Refinancing can provide several benefits, such as lower interest rates. By securing a new loan with a lower interest rate, you can save money on interest payments, freeing up funds for other uses. Improved loan terms. A refinance may offer more favorable loan terms, such as flexible repayment options or a longer loan term, which can ease your financial burden. Debt consolidation. Refinancing allows you to combine several loans into one new loan, making it easier to manage your debt and possibly reducing your overall repayments. However, refinancing also has potential risks. Closing costs and fees. Refinancing can incur closing costs and fees associated with setting up the new loan, which may offset any potential savings. Extended loan term. Refinancing for a longer loan term often results in lower monthly payments but could lead to paying more interest in the long run, as you're spreading repayments over a longer period. Loss of security. In some cases, refinancing might require you to provide additional collateral, or expose you to the risk of losing your property if you're unable to meet the new loan terms. Debt consolidation explained. The process of debt consolidation. Debt consolidation is a financial strategy that involves combining multiple debts into one single loan. The primary purpose of this approach is to simplify your debt repayment process by merging your existing debts with various creditors into one consolidation loan. Essentially, you will take out a new loan to pay off your pre-existing debts, allowing you to focus on a single debt and make just one monthly repayment. In practice, debt consolidation could involve using a debt consolidation loan to pay off other debts, such as credit card balances, overdrafts, and personal loans. This process doesn't reduce the amount you owe, but it can make managing your debt significantly more straightforward. Benefits and challenges of debt consolidation. Some of the benefits of debt consolidation include simpler financial management. Having just one debt and one monthly repayment makes it easier to keep track of your existing debt and maintain a clear understanding of your overall liabilities. Lower interest rates. In some cases, a debt consolidation loan may offer a lower interest rate than the combined interest rates of your separate debts, This can ultimately save you money over time. Reduced monthly repayments. Consolidating your debt can lead to lower monthly payments, depending on the terms of your new loan. This can free up more of your income for other essential expenses. However, there are some challenges to consider. Longer repayment term. By consolidating your debts into a single loan, you may end up extending the repayment term. While this may make monthly repayments more manageable, it could also result in you paying more interest over time. Qualifying for a consolidation loan. To take advantage of this financial strategy, you need to qualify for a consolidation loan. This may be difficult if you already have a poor credit rating due to missed repayments or high levels of debt. In summary, debt consolidation can be a helpful tool for managing your finances, as long as you carefully weigh up the potential benefits and challenges. It's essential to work out whether consolidating your debts is the best course of action for your own personal financial situation. Lenders and financing. Role and influence of lenders. Lenders are financial institutions or individuals that provide loans to borrowers. When it comes to refinancing and debt consolidation, lenders play a significant role in determining the terms and conditions of the loan. They assess your credit history, financial situation, and other factors to decide the interest rate, loan amount, and repayment terms. The lender's decision-making process is critical in determining whether debt consolidation is a suitable option for you. Different lenders may offer varying interest rates and terms, so it's important to shop around and compare multiple offers before making a choice. Credit scores and their importance. Your credit score is a crucial factor in determining your eligibility for a debt consolidation loan. A higher credit score indicates a lower risk for the lender, which means you are more likely to be approved for a loan with favorable terms such as lower interest rates. To maintain a good credit score, you need to ensure timely payments on your existing debts, avoid accumulating excessive debt, and monitor your credit report for any inaccuracies. While refinancing and consolidating your debts can help to improve your credit score over time, it's essential to be aware of your credit rating and take appropriate steps to keep it healthy. When applying for debt consolidation loans, lenders will assess your credit score to evaluate your creditworthiness and determine the terms of your loan. Therefore, it's essential to maintain a good credit history and monitor your credit score before applying for refinancing or debt consolidation. Remember, staying on top of your finances and making informed decisions will put you in a better position to manage and eventually become debt-free. Types of debt consolidation. Debt consolidation is a process that helps simplify your financial situation by combining multiple debts into a single loan and payment. This can make your repayments more manageable and potentially save you money on interest. There are two main types of debt consolidation loans: secured debt consolidation and unsecured debt consolidation. Secured debt consolidation. A secured debt consolidation loan is backed by an asset, such as your home or vehicle, which acts as collateral for the loan. This means that if you fail to make the repayments, your property or vehicle could be at risk. However, secured loans tend to offer lower interest rates compared to unsecured loans, as the lender has the collateral to fall back on if you default on your loan. To obtain a secured debt consolidation loan, you'll need to have an asset of sufficient value to provide as collateral. This might be your home, vehicle, or potentially other property. Keep in mind that there's always a risk involved in using valuable assets as collateral, so weigh your options carefully and consider the potential consequences of defaulting before committing to a secured loan. Unsecured debt consolidation. On the other hand, an unsecured debt consolidation loan does not require any collateral. Instead, the lender bases their decision on factors such as your credit score, income, and other financial details. Since the lender takes on more risk in this type of loan, you can expect higher interest rates compared to secured loans. Unsecured debt consolidation loans can be a good option if you don't have valuable assets to secure the loan, or if you're not comfortable with the risk involved in putting your property or vehicle on the line. However, remember that higher interest rates may mean you'll pay more in the long run, so carefully consider whether an unsecured debt consolidation loan is the best choice for your financial situation. When making a decision between secured and unsecured debt consolidation loans, you should carefully consider the pros and cons of each type, taking into account the potential risks, interest rates, and the impact on your overall financial situation. It's also a good idea to seek professional advice from a financial advisor or debt counselor to help you make the most informed decision for your unique circumstances. Impact of debt consolidation on finances. Budgeting and cash flow management. Debt consolidation can have a significant effect on your budgeting and cash flow management. By combining multiple debts into one, you may be able to reduce the overall amount you have to pay each month. This could potentially free up some cash that can be used for other expenses, making it easier for you to manage your budget. It's essential to remember that when you consolidate your debts, you should still focus on paying off the new loan as quickly as possible. You don't want to fall into the trap of using the extra cash freed up from lower monthly repayments to take on more debt. Be disciplined and plan how you will allocate the money to make sure you meet your financial goals. Potential financial impact. The financial impact of debt consolidation can vary depending on your individual circumstances, such as the total amount of debt being consolidated and the new loan terms. It's crucial that you understand the total cost of the new loan and compare the interest rates and total repayment amounts to ensure you're making a wise decision. For example, if you have multiple credit card debts with high interest rates, consolidating them into one loan with a lower interest rate could potentially save you a significant amount of money in interest charges. However, make sure to consider any fees associated with the new loan as well, such as origination or early repayment fees. Debt consolidation could also have an effect on your monthly repayment amount. If you consolidate your debts into a loan with a longer repayment term, your monthly repayments will likely decrease, helping you with cash flow management. However, a longer term could increase the total amount of interest you will pay over the life of the loan. Always compare the numbers to understand the true cost of your new loan. In conclusion, debt consolidation can have both positive and negative impacts on your finances. You should carefully consider your own financial situation, your ability to commit to the repayments, and any potential savings from consolidating your debts before making a decision. Remember, it's always a good idea to consult with a financial advisor if you're unsure about the best course of action for your particular circumstances. Debt consolidation alternatives. When considering debt consolidation, it's essential to explore alternative options that might be better suited to your financial situation. In this section, we'll discuss two primary alternatives: debt management plans and insolvency and other alternatives. Debt management plans. A debt management plan, DMP, is an arrangement between you and your creditors to help you repay your debts at a more manageable pace. With a DMP, you can negotiate new repayment terms that may include lower monthly payments or interest rates. To set up a DMP, you can work with a licensed debt management company or a free debt advice service like Citizens Advice. Here are some benefits of a DMP. More affordable monthly payments. Potential for reduced interest rates. Creditor harassment may decrease. However, keep in mind that a DMP might not be the best option if you're unable to commit to the new payment terms, or if your debts are too high for a manageable repayment plan. Insolvency and other alternatives. If your debt situation is more severe, you may need to consider more drastic measures, such as insolvency. Individual voluntary arrangements, IVAs, are formal agreements between you and your creditors, where you agree to repay a portion of your debts over a fixed period, usually 5 years. An IVA is legally binding, and you'll need the assistance of a licensed insolvency practitioner. IVAs can be a good option if you want to avoid bankruptcy, but they may affect your credit rating and come with upfront fees. Learn more about IVAs at this Citizens Advice page. Another insolvency option is bankruptcy, which involves having your debts written off by the court. While bankruptcy can offer relief from overwhelming debt, it can also have serious consequences, such as losing control of your assets and a lasting impact on your credit score. Bankruptcy should be considered a last resort and only after seeking professional advice. In summary, when exploring alternatives to debt consolidation, It's crucial to consider your financial situation and consult with expert advice to determine the best course of action for you. Borrowing and loan repayment. Understanding repayment terms. When you take out a loan for refinancing or debt consolidation, it's essential to understand the repayment terms. Repayment terms outline the duration of the loan, interest rates, and monthly payments you're required to make. Longer repayment periods often mean lower monthly payments, but this can also result in paying more interest overall. It's crucial to find a balance between manageable monthly payments and a reasonable loan term, so you don't end up paying more than necessary in the long run. To make informed decisions, consider comparing different lenders and their loan offers. Pay attention to any fees associated with the loan, as well as the annual percentage rate, April, as this will be a key factor in determining the total cost of borrowing. Implications of default or delayed payment. Failure to meet your loan repayments can have significant consequences. If you default on your loan or make delayed payments, you may face penalties, additional interest charges, and a negative impact on your credit rating. This can make it difficult for you to secure future loans or obtain favorable interest rates. It's vital that you budget effectively to ensure you can afford the monthly repayments and the impact they will have on your overall financial situation. If you find yourself struggling to make the payments, communicate with your lender as soon as possible. They may be able to offer alternative solutions or payment plans to alleviate financial strain. Remember that it is always better to address the issue promptly rather than avoiding it, as lenders are typically more inclined to help when you proactively seek assistance. Specific cases of debt consolidation. Business debt consolidation. When it comes to consolidating business debt, you may consider taking out a new loan to pay off multiple existing debts. This can make repayments easier to manage with a single monthly payment. It is crucial to find out how much you can get and how much it will cost without hurting your credit score. For businesses with multiple loans and credit lines, consolidating debts can help simplify financial management and potentially lower the overall cost of borrowing. Converting various loan payments into one single payment makes it easier to budget accordingly. It might also help you negotiate better interest rates or repayment terms with your lenders. Small business and debt consolidation impact. Small businesses can particularly benefit from debt consolidation, as it helps improve cash flow and supports growth too. By streamlining your monthly payments, you can free up funds to invest in essential aspects of your business, such as hiring new employees, expanding your product range, or enhancing your marketing efforts. However, it is vital to approach debt consolidation with caution, ensuring it aligns with your long-term business strategy. Consider the impact of consolidation on your overall financial health, comparing the new loan's interest rate, fees, and repayment terms with those of your existing debts. Additionally, evaluating the potential effects on your credit score is crucial, as this will determine your future ability to secure further business loans and financing. In summary, debt consolidation can be a valuable tool for businesses, particularly small ones, to manage their debt, improve cash flow, and support growth. By consolidating debts carefully and strategically, you can ensure it positively impacts your business in the long run. Conclusion and key points. In summary, refinancing and debt consolidation are two viable options to manage your financial commitments. We will now outline the key points, advantages, disadvantages, and alternatives to help you make an informed decision. Refinancing involves replacing an existing loan with a new one, ideally with better terms such as a lower interest rate, which can save you money in the long run. One major advantage of refinancing is that it can potentially reduce your monthly payments, making it more manageable and allowing you greater control over your finances. However, a potential disadvantage is that you may end up paying more in interest if you extend the loan term. Debt consolidation, on the other hand, involves combining multiple debts into a single loan with one provider that best suits your needs. The primary advantage of debt consolidation is the simplicity of having just one monthly payment, which helps you keep track of your financial commitments. Additionally, debt consolidation can potentially lower the overall interest rate, saving you money. Disadvantages of this method can include higher overall payments if the loan term is extended or the possibility of increased fees. Before deciding to refinance or consolidate your debt, it's crucial to explore alternatives as well. For example, consider speaking to a financial advisor who can provide tailored guidance based on your specific circumstances. Additionally, you could seek debt counseling through a non-profit organization or explore debt management plans, which can help you regain control of your finances without taking on additional loans. To make the best decision for your situation, carefully weigh the advantages, disadvantages, and alternatives alongside your financial goals and constraints. Remember that both refinancing and debt consolidation are tools to help you regain control of your finances and ultimately work towards a more stable financial future. What are the advantages of debt consolidation and refinancing? Debt consolidation and refinancing can offer several benefits. By combining multiple debts into a single loan, you may simplify your financial management, leading to an easier repayment process. This can also help reduce the total amount paid in interest and potentially lower your monthly payments. Moreover, you may be able to secure a better interest rate by refinancing, which can save you even more money in the long run. Which factors should be considered before consolidating debts? Before consolidating your debts, take into account various factors. Firstly, calculate the total amount you owe and consider the interest rates on your current loans. Then, compare these rates to the interest rate of the potential consolidated loan. Look out for any fees associated with debt consolidation, such as early repayment charges on existing loans or origination fees on the new loan. Additionally, consider the repayment term of the consolidated loan, as stretching out payments over a longer period could lead to higher total interest paid. Can debt consolidation help reduce interest rates on loans? Yes, debt consolidation can help reduce interest rates on loans, particularly if you have high-interest debt from credit cards or unsecured personal loans. By consolidating these debts into a single loan with a lower interest rate, you can save on the total interest paid over the repayment term. Keep in mind that the exact reduction in interest rates may vary depending on the individual lender and your credit history. How does refinancing affect my credit score? Refinancing can have both positive and negative effects on your credit score. Initially, your credit score may be impacted when you apply for a new loan, as this triggers a hard inquiry on your credit report. However, in the long run, refinancing can potentially help improve your credit score by lowering your credit utilization and by showing consistent, on-time payments on the new loan. What types of loans are best suited for debt consolidation? Debt consolidation works well for high-interest debts, such as credit card balances and personal loans. It is also suitable for handling multiple debts from different lenders. Keep in mind that secured loans, such as mortgages and car loans, might not be the best candidates for debt consolidation, as the collateral involved could put your assets at risk if you fail to meet the new loan's repayment terms. Are there any alternatives to debt consolidation and refinancing? Yes, there are alternatives to debt consolidation and refinancing. One option is a balance transfer credit card, which allows you to transfer high-interest credit card balances to a new card with a lower or 0% introductory interest rate. Another alternative is working with a debt management agency, which can help you negotiate lower interest rates and create a personalized repayment plan. Lastly, you could explore debt settlement, where a company negotiates with your creditors to decrease the total amount you owe, though this option can damage your credit score. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.